The Federal Reserve is reportedly preparing to cut interest rates next week, but this isn't a normal cut. This move is happening while inflation remains stubbornly high and the labor market shows serious signs of cracking. This creates a dangerous economic contradiction we haven't seen in decades, a policy error of historic proportions. For the prudent precious metals investor, this isn't just news, it's a catalyst. Stick around until the end and I'll show you the two specific steps being taken right now and the one critical mistake many investors are making as gold hits new highs. This content is for informational and educational purposes only. It is not financial advice. Viewers should conduct their own research and consult with qualified professionals before making any investment decisions. Think of the current economy as a pressure cooker. On one side, you have persistent inflation, eroding purchasing power. On the other, you have a weakening job market. The true unemployment rate, which includes discouraged workers, sits above 8%. Cutting rates into this environment is like turning up the heat on that pressure cooker with no release valve. This is such an unusual move. One prominent economist noted, and I quote, "It's hard to imagine when they've done that before, because inflation is above their target and rising, and they're going to cut into that." This uncharted territory fundamentally weakens confidence in paper currencies and strengthens the case for historic stores of value. The market is already voting. Gold is up 37% year to date. Silver is up 41%. Both recently broke to new all-time highs. This isn't a coincidence. Weak data plus strong inflation plus anticipated monetary expansion creates a perfect tailwind for precious metals. But critically, mainstream sentiment isn't euphoric, it's nervous. This suggests these new highs may not be a market top, but a new foundation, a launching point. The trend is firmly in place, and as one analyst asserts, for those waiting on the sidelines, the longer you wait, the higher the high is going to be. Let's recap. First, we have a potentially historic Fed policy error. Second, this environment is a primary catalyst for hard assets. So what can investors consider? A preservation approach involves using this strength to strategically increase physical allocation by a small percentage, focusing on low-premium bullion to maximize capital efficiency upon entry. An opportunity approach involves viewing these new highs not as a deterrent, but a confirmation of a major trend, a signal to research assets leveraged to the ongoing bull run in metals. And a universal rule, regardless of strategy, ensuring secure private storage solutions for physical metal is an absolute necessity. And that one critical mistake? It's panicking and chasing high markup numismatic products instead of sticking to liquid, low premium bullion. In a momentum market, capital efficiency is key. The Fed's next meeting concludes on September 18th. The data suggests this isn't the time for hesitation, but for prudent strategy. The question isn't if this environment supports higher metals prices, but how investors are adjusting their allocations to protect themselves. If you're focused on preserving wealth through intelligent contrarian strategies, subscribe for more objective analysis. Thank you for watching.